if we look at earnings, so far we have 88% of the names beating, and they're beating to the tune of 16% or so. Earnings are what drives the market. It doesn't happen right away. The market hasn't really favored or benefited some of the top line earnings reporters this season so far, but I think that that's going to play out in the next year. I think that the variant, it's of course an issue and a risk to the market, but I think that we sort of know what we're dealing with now. I think that we'll see more people getting vaccinated. But in the meantime, there's this big demand to get back to life, to sort of get back to traveling, to get back to the workplace and things like that. And I think that that's going to push the economy forward. We have trillions of dollars in the market. The companies out there are just laden with cash, billions of dollars of revenue. I think we go up from here. And I think that right now that there are a lot of opportunities in the market to really, give portfolios and investors some access to gains for the rest of the year.
Okay, Paul, your comments, and I guess that would mean that some of the reopening stocks that have, or names that have pulled back a little recently, is it a time to revisit those and maybe take new positions?
Yeah, I think so, Joe. So what you look at is one of the factors of this market since the lows last year that has really impressed us is the ability of the market to rotate smoothly without causing big hiccups in the market. Last September, we saw tech peak on a relative basis, consolidate for about 6 months. And what happened during that period? Energy, financials, industrials, and materials picked up the slack. Then we got to the end of the first quarter of this year. Interest rates were rising, and they peaked at the end of the first quarter. And then from that point on, those reopening and cyclical sectors took a pause, and the FANG-type stocks and the growth stocks started to outperform again. And I think as interest rates have come down so far, and we got to 1.17 yesterday, as we start to see rates rise, which we expect to see here a bit, I think some of these sectors that have been consolidating for almost 6 months now, they're going to start to pick up momentum and take the baton back from tech and the growth trade. You look at the small caps; they never quite hit 10% correction on a closing basis, but just about a week ago they got there on an intraday basis. Already, that's the longest correction without a 10% rally, and this is the 7th longest in the history of the Russell. So we've had this real sideways trading action. And when you look within the Russell, we always talk about valuations in the market being high. But in the Russell, there's a number of stocks where you can find profitable companies in the Russell trade an average PE of about 17 times earnings versus 25 times for the S&P 500.
Sylvia, listening to Paul, he was talking about we've had these orderly rotations, and then described a lot of things that went up. It almost sounded like a description of what easy money does in terms of lifting all boats. But you still feel that you can find more attractive names that are going to maybe be selectively do better than others with all the easy money. So that you see what I'm saying? Everything is going up. I mean, NFTs are going up. Everything is going up. So it just makes me wonder whether it's real or whether it's Fed.